All right, welcome to the ALEF Fund webinar on House Bill 149. My name is Nicole Flom. I am the ALEF Fund manager. Today we have with us Todd Karansky and Jonathan Feldman. They are going to be presenting the information regarding the tax law to you. And I'm going to start off with just a brief introduction on the ALEF Fund. I'm sure most of you are already very familiar with how it works, but I know that we also had invited some CPAs and accountants, so I just wanted to make sure that I'm just giving a quick overview of what the ALEF Fund is, how it works, and why House Bill 149 would affect somebody who is making a contribution. So the ALEF Fund was established in 2008 in response to new state tax legislation. It is an education expense credit that allows you to redirect a portion of your Georgia state taxes to going towards scholarships to a private school. We currently have 21 partner schools, which include preschools, day schools, and high schools. And we are the only SSO, which is a student scholarship organization, that exclusively represents Jewish schools. The breakdown in terms of how you can sign up for the ALEF Fund is based on your tax filing status. Today, we are focusing on the folks who are a pass-through entity, which in the past, your only option was to sign up for $10,000 per individual if you had an LLC, an S Corp, or were a partner in a partnership. With House Bill 149, this may affect whether or not you sign up in the same way that you've done in the past, or sign up in a similar fashion to the way a C Corp signs up, which is 75% of their Georgia tax liability. So I have the other breakdowns on there as well for reference. And that is just kind of the quick overview of ALEF, and we will just jump right into the tax laws.
Thanks, Nicole. Appreciate everybody joining us today for the ALEF Fund webinar. For those of you who don't know me, my name is Todd Karansky. I am a tax partner at Williams, Bonator & Libby and have been in public accounting for over 21 years. And so today I'll walk you through the history of the federal tax legislation, which led us ultimately to the Georgia House Bill 149. After that, I'll turn it over to Jonathan Feldman, and he'll talk about the specifics of the Georgia House Bill 149 legislation and how it impacts ALEF Fund donors. So to start the chronological order of the federal tax legislation, which spurred the creation of Georgia House Bill 149, we need to go back to December 2017, when the 2017 Tax Cuts and Jobs Act was signed into law and imposed a limit of $10,000 in state and local taxes that can be allowed as an itemized deduction on an individual income tax return. Throughout this presentation, we'll refer to that $10,000 limitation as the SALT cap. To combat these SALT cap limitations, many states have been passing legislation to work around such limitations. This legislation includes entity-level income taxes for pass-through entities that file as a partnership or S corporation tax return. The reason behind these pass-through entity income taxes is to try and obtain a tax deduction on the entity's tax return for state taxes imposed on and paid by the entity, rather than having it limited or completely non-deductible when paid at the individual level due to the SALT cap limitations. Essentially, states are now enacting pass-through entity income tax legislation to function as SALT cap workarounds. I should also point out that there are also some states like Georgia that have programs which allow for a taxpayer to redirect their tax dollars to a charitable organization in return for a state income tax credit. Prior to subsequent tax legislation, this allowed a way for individuals to work around the SALT cap by donating to an organization such as the ALEF Fund in order to obtain both a federal charitable deduction and also cover part of their state income tax liability. While a state program such as contributing to Georgia Student Scholarship Organization was created before the 2017 TCJA and wasn't designed to be a SALT cap workaround, it ended up being a SALT cap workaround. Next slide, please, Nicole. So this leads us, next slide. Thank you. So this leads us to the 170A-1 regs.
Sorry.
Slide before that. It's okay. So in the 170A-1 regs, the IRS essentially put a stop to SALT cap workarounds for state programs offering state income tax credits on certain charitable or donations. The regulations require a charitable contribution deduction under Internal Revenue Code Section 170 to be reduced by the amount of any state or local tax credit that the taxpayer receives or expects to receive in consideration for the contribution. For example, if a state grants a 70% state tax credit pursuant to a state tax credit program and the taxpayer contributes $1,000 pursuant to that program, the taxpayer receives a $700 state tax credit. In such case, a taxpayer who itemizes their deductions must reduce the $1,000 federal charitable deduction by the $700 state tax credit, thus only getting a $300 deduction instead of a $1,000 charitable deduction. An exception applies if the state and local tax credits received by the taxpayer do not exceed 15% of the contribution. Thus, in my example, if a $1,000 contribution only resulted in the state tax credit of $150 or less, the entire $1,000 contribution is allowed as a federal charitable deduction. While the IRS has put a stop to SALT cap workarounds and deducting charitable donations for payments made to state programs that allow a state tax credit, there has been legislation, which we'll discuss, that has been released over the past few years, which allows for some ways where certain entities contributing to a state program may be able to get a fair federal tax deduction for paying state taxes or obtaining a state tax credit for payments to a state program, thereby avoiding the SALT cap limitations or exclusion of a charitable deduction. Next slide, please. So this leads us to Revenue Procedure 2019-12, which the IRS issued on December 28, 2018. This provides certain safe harbors for businesses to claim ordinary and necessary business expenses under Code Section 162 for certain payments made by C corporations or pass-through entities to a charitable organization if the C corporation or pass-through entities receive or expect to receive a state or local tax credit in return for these payments made to the charitable organization. These safe harbors allow for a C corporation to treat a contribution in exchange for a state tax credit as a deductible ordinary business expense under Code Section 162. The revenue procedure also allows the safe harbor to pass-through entities to take a Section 162 deduction for a contribution in exchange for a tax credit only if the credit is for a tax other than an income tax. However, a pass-through entity may still be allowed a 162 deduction for a contribution in exchange for a state income tax credit under a safe harbor rule if the payment is made with a business purpose. So this leads us to 162-15 regs, which then clarify and expand upon the RevPOC 2019-12. We can go to the next slide, please. So under the 162-15 regs, which were issued on August 11, 2020, these regs confirm that a payment made by a pass-through entity to a charity, such as an SSO, Student Scholarship Organization, may qualify for a federal ordinary business expense deduction, even when the owner receives a state income tax credit for the payment. The regulations clarify that the key component to having such a payment treated as an ordinary business expense deduction is that the payment to a charitable organization bear a direct relationship to the taxpayer's business and are made with a reasonable expectation of financial return commensurate with the payment. However, the financial return expected does not necessarily have to equal the payment. As a result of these regs, a business may be able to ultimately take a federal business expense deduction if they reasonably believe payments to a program will generate a significant degree of name recognition and goodwill in the communities where it operates and thereby increase its revenue. Next slide, please. And so finally, this leads us to IRS Notice 2020-75, which was released on November 9, 2020. And this is really the final piece that allowed Georgia legislators to become comfortable that a Georgia pass-through entity income tax would provide for a federal tax deduction and thus a workaround for the SALT cap limitations. This notice was issued in reaction to the fact that several states were already implementing ways for partnerships and S corporations to pay entity level state income taxes. So under notice, IRS notice 2020-75, the IRS responded to what the states were doing and confirmed that they would allow a federal ordinary deduction for state and local income taxes imposed on and paid by a pass-through entity in computing its federal taxable income or loss for the year. Thus, state income taxes imposed on the partnership or S corporation's tax return, whereby the entity is paying the state tax with respect to its income, will be considered a tax-deductible expense for the entity, and such taxes are not subject to the $10,000 state and local tax cap that is imposed on individual income taxes. In reaction to this IRS notice, which is essentially blessing a federal ordinary tax deduction for entity level state income taxes, several states, including Georgia, have since added an entity level income tax for pass-through entities filing a partnership or S corporation tax return. So with that, this leads us to a discussion on the Georgia House Bill 149 legislation, which from here, I'll let Jonathan take over.
Thank you. Yep. Thanks, Todd. Good morning, everyone. Apologies, I'm recovering from a little cold here, but so what did Georgia do? So last legislative session, so our 2021 legislative session, the Georgia legislature enacted and the governor signed House Bill 149, which is a SALT cap workaround, like many other, probably 24 other states have passed. Although it's a bit unique in one of its features that I'll get to. But it was passed during the 2021 session, and it first becomes effective for the 2022 tax year. It's an annual election that can be made by any pass-through entity. So that'd be a partnership, an LLC, an S corp. The election is made on the entity's Georgia income tax return. So if it's first effective for the 2022 tax year, you'd file your 2022 Georgia return sometime in 2023. So you really aren't going to make your 2022 election until sometime in 2023 when you file your return. So during, now in 2021, you think you know what you may do in 2022. During 2022, you think you know what you may do with the election, but you're not going to actually make that election until sometime in 2023. So there's lots of, there can be some federal changes. There's lots of things that may change between now and when you actually file your return. So that's one thing to keep in mind with regard to, there's other states that require that you get pre-approval and you register in advance to make the election. Georgia's is made on the return. So the Georgia PTE election, it applies to only the Georgia sourced income of the partnership of the PTE. So if you have a PTE that has that's doing business in multiple states, it's only the Georgia sourced income that's subject to tax at the entity level in Georgia. The income that's not Georgia sourced, that's sourced to another state, that would not be taxed at the entity level in Georgia. The thing that makes Georgia's legislation and election a little bit different than other states is when the pass-through entity makes the election, that income is taxed at the entity's level, just like every other state. But the income does not also flow to the individual member's return. So if the individual member, say, made $50,000 of Georgia sourced income, the entity would pay tax on that $50,000. The individual member would start with federal taxable income and report the $50,000, but then would quickly subtract the $50,000. And in that case, if that was their only income, they'd actually have zero Georgia reported income. What other states have done, other states have the entity pays tax on the income, but the individual gets a refundable credit based on the tax that the pass-through entity paid. But that's not the path that Georgia chose to make. There was some hesitancy to start allowing additional refundable credits in Georgia. But based on the final bullet point here, I think that that may be something that may be reconsidered, and it's possible that that particular thing could be amended via technical corrections bill early in 2022. Last point on this slide, this is a pretty big change of how pass-through entities can be taxed in Georgia, and so the Department of Revenue put together a small working group of practitioners to come up with regulations implementing House Bill 149. I was part of that small working group, and I think the Georgia Department of Revenue have been pretty open to making the regulations as taxpayer friendly and flexible as possible. Part of that is going back to my prior point that you may think you're going to make an election, but you end up not making the election. And how do you transfer estimated payments, and how would you deal with credits? There's language within the proposed regulation that addresses that. DOR has issued the proposed regulation, the working draft of that. They issued it, I think, last week, October 29th, and it's open for public comment. Anyone can write in and give public comment or participate in the hearing, and that would be on November 29th, so next month or the end of this month. I suspect that many on this call will want to actually recommend reviewing those proposed regulations, and if you have any concerns to see about issuing comments to revenue, and they do read comments, they do consider them, and very well may make a change. The issue that Todd spoke about, the issue of whether the payment, the contribution to the ALEF Fund in lieu of a state tax payment, whether that's deductible or federal, again, that's a federal issue. It's not one that can be addressed or fixed or clarified by the Georgia Department of Revenue. Deductibility for federal purposes of the contribution in lieu of a state tax, again, that's a federal issue, so it couldn't be addressed in these regulations. And so, Nicole, next slide. So moving into what should everyone consider when thinking about their contribution for 2022? So if the donor if you're not a partner, or not your member of a pass-through entity, or you're a member of a pass-through entity that doesn't intend to make the House Bill 149 election, then House Bill 149 again should have no impact. If you're a corporate donor, and you've previously been a corporate donor and can contribute up to 75% of your Georgia tax liability, again, House Bill 149 should have no impact because it's only addressing an election for pass-through entities, not corporations. Nicole, next slide. So here's kind of where the rubber meets the road here. So for donors of a pass-through entity that do intend or think they may make the House Bill 149 election at this point, as I think Nicole pointed out in the very beginning, now similar to a corporation, the pass-through entity can contribute up to 75% of the Georgia income tax liability. But again, as Todd mentioned, deductibility for federal purposes of that contribution, it should be closely analyzed based on the IRS guidance. And again, we strongly recommend consulting your tax advisor on the deductibility of the contribution. If you're an individual member of an electing pass-through entity, this is one of the quirks of Georgia law. So if you're an individual member of a partnership, in prior years, the amount that you as an individual member could contribute was based on the amount of income flowing through from the partnership to you. Well, now, if you're a member of the same partnership, but that partnership makes the election, like I mentioned, that income that's taxed at the entity level is not going to flow to the partner. So an individual member a partner that wants to make an individual contribution, if they're a member of an electing partnership, they would not be able to consider the amount that's taxed at the entity level in Georgia for purposes of determining how much contribution they could make as an individual level. But I would make one other point that, again, Georgia, the PT election only impacts Georgia source income. So if you have a multi-state partnership, the non-Georgia sourced income, that could be considered for purposes of how much an individual partner could contribute. But again, you'd also want to consider whether you're getting a credit for state taxes paid in other states. Two more quick points, and then I think we'll open this up for questions. If you're an individual member of an electing partnership or a non-electing partnership, and you've contributed based on your filing method, not as a member of a partnership, but just as married or single or married or head of household, and you've given at the $1,000, $1,250, or $2,500 level. Again, there's no change to that. I mean, if you're contributing based on your filing status and not as a member of a partnership, there'd be no change to that. And then the last point, prior to House Bill 149, a pass-through entity could register to contribute to an SSO on behalf of its members, and on the registration form, you would designate how much of the contribution is allocated to each member. So essentially, the partnership would be making the contribution, but it would flow through to the members. Under House Bill 149, if that same partnership makes the election, and you went through the same process, again, those credits are not going to flow through to the individual member. And one thing that we do have in the regulation, because we're in November of 2021, you may not actually make the election until October of 2023. If you go through the process of making a contribution at the entity level, and then ultimately you decide the entity is not going to make the election, we did put a provision in the regulation that those credits can flow to the individual partners because the entity did not make the election. But if that happens, those credits would be subject to the individual limitations. So, for example, if each partner was allocated $15,000 of contribution at the partner level, and they decide not to make the election, and it did flow up to the partners, you'd be limited to 10,000. So something to keep in mind if you're considering doing it at the entity level. What would be the impact if you ultimately decided not to make the election down the road? And so with that, Nicole and Todd and Jeff, happy to open this up for questions. I saw some questions coming through.
Yeah, I've got them written down, so I'll just take them in the order that they came in. So the first question we got was, is the HB 149 election made for all members, or can it be made for individual members?
It's for everyone.
It's an all or nothing.
Yeah, and it can only be made by an entity that has, I think, natural owners. So if you've got corporate owners of a partnership wouldn't be eligible to make the election.
Basically, if you're an eligible owner, an eligible S Corp owner, all the members of like an LLC taxed as a partnership would have to be eligible S Corp owners, essentially.
Yeah.
For the election to be allowed.
Next question, I think we touched on this a little bit, but maybe expanding on it. If a PTE makes the PTE election and allocates some of its tax to ALEF, can the owners of the PTE also fund $10,000, assuming other income flowing to them in Georgia, but not allocable for the PTE tax?
From a different partnership?
It could be a same partnership, but I think you touched on that, Jonathan, right?
Yeah.
If only 50% of your income is allocable to Georgia, so the other amount is flowing through to you, can you use that other amount to support your own $10,000 contribution?
I believe the answer would be yes to that.
I think yeah, Todd, I think you're right. The answer may be yes, although it may be difficult to fall under that fact pattern.
Yeah, and another thing is how the other, the ordering of the credits, and you have
Right.
taxes paid to other states, and you're getting a credit in Georgia for that, how the ordering of that would work.
Right. I think that's the big deal, is you want to be careful about the fact that if all that other income is subject to tax in other states, that you're going to get another state tax credit in Georgia. Where are you going to have utilization of your ALEF fund contribution at that time?
Right. And if you don't use it, I think, Jeff, all of SSO credits carry forward 5 years if you earn them but don't use them. So
That's right.
They don't disappear. They do carry forward, but
the 10,000 does not. The 10,000 is a use it or lose it. But the 75% does carry forward for 5 years.
well, I think if an individual partner made a contribution on their own at 10,000 and they couldn't use all 10, they used 7, I think the other 3 would carry over to the next year.
That's right.
Would-
I think it's a 5-year carry forward.
For the 10, not for the 10,000.
Not for the 10,000.
It's a use it or lose it for the 10,000. For everything else, it's a 5-year carry forward.
For the individual filers?
Individual filers that are basing their contribution on a flow through entity or disregarded entity income.
Okay. Excellent. We have one more. Oh, wait, a second. Oh, I heard someone else.
Sorry.
Go ahead.
Is a single member LLC able? Is a single member LLC who doesn't file a partnership return eligible for this treatment?
No, they're not eligible for the PTE election unless they elect S Corp status.
Thank you. I figured that.
Can one of you address the, from a school standpoint, how this might impact partnerships and LLCs who we used to renew on a regular basis, and how it might delay their decision and possibly decrease the amount of funding that we get next year?
Yeah, I mean, it's really a tricky question, I think, to answer fully. There's definitely going to be people impacted that, if they can't, I think the key is whether or not they can qualify as a necessary business expense, whether they're going to meet those 162 regs, if they make the PT election to treat this as an ordinary business expense, the contribution to the ALEF Fund. If they can't, and that's really, it's a particular facts and circumstances. Each person can have their own nuances to whether or not they can take the deduction, and they'll have to consult their CPA, tax advisor on such. But to the extent they can't get a business deduction, and they're going to and it makes sense for them to make the PT election, then they're going to have to find a different way to redirect. And they want to still contribute to the ALEF Fund, they're going to have to find a way to redirect. How they contribute to ALEF Fund. They may have to be able to only do 2,500, through other sources of income, or if, as we mentioned before, if their pass-through entity has sources of, not all their income sourced to Georgia, and they have a way of doing the $10,000 still, then that might be an option.
Yeah, my concern is we're kind of going back to the origins of ALEF, where people didn't understand what it was about, and they had to consult their CPA. And then after about 2 or 3 years, it became very easily understood and just an easy call to renew. And now this is even more complicated. And although we have the opportunity to receive more money at 75%, it's a very slow process that, if I heard you correctly, we may not know until October of 2023 how much we're actually going to be receiving. Is that right?
No, that I think the October 2023 reference was knowing whether a partnership or other pastoral was going to actually make the election. The amount of donations that ALEF Fund gets, I mean, that'd still be, you know, whatever they get next year.
Well, I'm just saying, if I'm talking to a partnership or sub S now, and they used to do $10,000, what would the expectation be in terms of knowing what their tax obligation was going to be for 2022? Would they, I mean, should I expect them to say, well, we're just going to wait until the fourth quarter of 2022 to see how things turn out? Or is it going to be something that we can rely on sooner? Because again, these funds for 2022, we receive in 2022 for our school year 2022-2023.
Paul,
And I'm
I
just trying to
think
see how we budget for that, and whether we should expect a slowdown and wait till 2023 to actually receive these funds, or if there's for year 2023-2024 academic year, or if we can expect a quicker response.
Paul, I can connect you with Todd offline.
Okay.
Since this is specific to schools and we want to make sure we get through everybody's questions.
Okay.
I had one more question that we didn't touch on yet. If you make the PTE election and the SSO credits only offset 75% of the tax, can we assume the remaining tax would be paid at the entity level like a C Corp?
Yes,
Yeah, that's right. Yeah,
that's correct.
or you could use film tax credits. There's ways you could do it.
I was getting a few more as we're chatting here. Does the election need to be signed by all partners or just the tax matters partner?
It doesn't say in the statute or regulation. It's just whoever's signing the return.
Yeah, most likely it'll be whoever's signing the return.
Can you please summarize the benefits for a PTE to now file as an entity versus a pass-through? The benefit to the school is clear. So what's the benefit to the PT? Is there a benefit to the PTE itself? I guess is the question. This is more, I guess to rephrase, I think what we're trying to get at with the PT election is this is more of a benefit to the owners of the PTE. This doesn't really provide any tax benefit per se to a pass-through entity, whether it elects or doesn't elect into this PTE tax system.
Yeah, I think that's right. I mean, the individual owners are subject to the 10,000 SALT cap. So the idea is the PTE, if they're paying tax at the entity level instead of the partner level, they're not subject to the SALT cap. So that is the benefit. The complication is, as we've addressed, is when you start paying part of your state tax as through one of these charitable contribution programs, and whether that is deductible as the direct payment of state tax would be.
Right.
Right.
And just to confirm for everybody, I think there was another question. The rate in Georgia on the PTE would be 5.75%, or whatever the rate may change to over time.
Yeah, it's the same rate as
it's the highest individual
else.
rate.
That's right. It's the same as the corporate rate or the highest individual rate.
All right, last call for any further questions that we can answer before I wrap us up. I also want to say, if you do have any questions that you weren't able to get answered on this call, feel free to send me an email. I'll put up my contact information momentarily. So this is not like a last chance or you don't get your questions answered. So two more things that I just wanted to share before we close out is that if you are currently interested in signing up on the entity level, the way that you would do so on our site is that you would change your tax filing status to a C Corp. I understand that you may not necessarily be a C Corp, but we are in the process of building a new site. And so in the process of our transition, we just haven't made that change to allow you to say that you're a S Corp or LLC or a partner in a partnership, choosing to do it on the entity level. That will be available on the new website. But currently, if you want to sign up, you would select C Corp, and that will allow you to then put in your business name and the EIN, and then allow you to make your select your contribution amount, which would be at the 75% level. So it won't max you out at $10,000. You're always, of course, welcome to reach out to me directly if you have any questions or need help with signing up, but I just wanted to make everyone aware of that change in terms of how it looks on our website. And then as I just also wanted to make everyone aware that this presentation should not be considered tax advice. So make sure that for your individual circumstances, you're still consulting with your tax professional to determine what's going to be best for you in terms of contributing to the ALEF Fund for this year. And you can see my contact information is below. So you can email me at info@aleffund.org or give me a call at 678-222-3739. And I will, if I am not able to answer your question, I will consult with Todd or Jonathan, who were our presenters today, and see what we can help you guys out with. And so that is everything for today. Thank you so much for your participation. And I look forward to hearing from all of you in the future.
Thanks, everybody.